Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending August 1st, 2025. So the title says it all, it's Liberation Day version 2.0. The market today is reacting negatively to that. That means that there was still some optimism in the markets that maybe this day will come and pass and Donald Trump will just kick the can once again, but it seems that this is not the case. For now, we'll see. I mean, we've been used to stop and go for a few months and now. The tariff on Canada goes from 25 to 35% as of August 7. What the executive orders that were signed gives a bit of a delay for the customs crew in the US to just get adjusted to the new reality. I don't know if a week is enough for them, but he granted that to his people. And again, what was cited was fentanyl for Canada and the fact that we retaliated to the previous measures. So I'm sure behind closed doors, the demands are pretty clear, but publicly the demands are not clear on what Donald Trump wants from Canada. Maybe this morning the interesting story is comes from Switzerland, just to show how much this seems to be filled with improvisation and it's not clear what is wanted here. Switzerland was threatened with 31% tariff rate on April 2nd. What we read in the news this morning is that they were negotiating with the US and they felt that they were making good progress, and they were just blindsided by the announcement last night that it's 39% on them, despite the fact that they thought that they were close to a deal. So this is the situation that we're in. Liberation Day 2.0 is upon us right now. So maybe looking at the markets, the safe haven flows this week. Of course, money went to bonds, so positive return for bonds. For equities, negative pretty much everywhere except on the Nasdaq. We've had very strong prints from both Meta and Microsoft on Thursday, or rather Wednesday night. So market was reacting positively Thursday on those. So it did help a little bit, but we are seeing the markets getting more expensive in terms of valuations. So expensive in a sense that is not consistent with the tariff threats and the tariff situation that we are seeing. So markets here could be ripe for some profit taking, could be ripe for some volatility. But again, as I mentioned last week, geographical diversification across asset classes is very important in an environment like this. We are seeing Canada and the US that are expensive in terms of price to earnings. But when you look at Europe, you have a more affordable market. Expected growth for earnings, Canada and Europe, you're seeing good things versus the US, which is good but still middle of the road. So there are some opportunities. Timing those kinds of market moves, it's never a good idea. But again, as we mentioned, August tends to be low liquidity. There are many things, many brewing stories here that could be bringing doses of volatility. So make sure that you are well diversified, that you are invested in the market, but fixed income, corporate credit, global ex-US equities are all good places to invest money and to build a well-diversified portfolio in this environment here. Because if you're wondering where could the tariff impact could be the most, the strongest, well, likely it's in the US economy. Of course, tech could be well shielded from that, but for the rest of the market, there are some interesting spots here that we could see some volatility start brewing. So it's a complicated picture, but still, this is where we stand after 7 months are in the books in 2025. So now it's official for now that the US average tariff rate has jumped from 2.5% in 2024 to about 18% this year. So it depends on who you read. All of the tariffs that were announced, there's exemptions all over the place. Between 18 and 20% is the number that everyone's coming up with. The history of tariffs is here. You can always, I encourage you, if you want to dig a little deeper, you can go on LinkedIn and you can download the PDF of this presentation here. But a rule of thumb that is coming up in research is that 1% on tariff equals about 0.1% on headline inflation. So that means that going from 2.5 to 18%, let's say it's about 16% rise in tariffs this year. That would lead to about 1.6% boost on US inflation, and we're at about 2.5, so that means that we could go all the way to about 4.1% somewhere in 2026. So in this environment, it's very tough for the Fed to cut rates if inflation is seen getting stronger, and if inflation is rising, this is paid by importers. That means that they're passing the costs along to the consumer. So if prices are rising because of a cost shock, a supply shock here coming from higher taxes, that means that they will be likely buying less. So that means that you have stronger inflation, weaker growth. So that brings you into the stagflation environment. And in stagflation, usually you want to have gold in stagflation, but commodity equities are not doing as that well. It's a negative average monthly return for equities when you're in a stagflation environment, and fixed income is not reacting that well either, because yes, you have slower growth, but you have higher inflation as well. So it's not the best environment for risk assets. So this is the risk here that this brings us into a market environment that is less favorable to investors. So I mentioned most of it, but just to get back to the details on what was announced. Again, 35% on Canada, citing fentanyl. The exemptions from USMCA are quite important here. According to the Bank of Canada's estimate, 95% of Canadian exports of goods should be exempt from those tariffs when everything is taken into account. 100% of our exports of oil are exempt from tariffs, so it shouldn't. There will be some sectoral, some regional impacts for sure, but overall, this is not that dramatic for the Canadian economy as a whole. Mr. Carney is disappointed, and there was a 90-day extension given to Mexico. So maybe one editorial comment here is that we mentioned that at the beginning of this thing, but maybe the best strategy was for Canada and Mexico to work hand in hand against the US to make sure that they protect what we have and to make sure that we protect the USMCA going forward. This is not what was done. Maybe the strategy of negotiating one-on-one with the US was not the winning strategy here for Canada. We'll see what kind of a deal eventually we get, if we get a deal. But again, it's hard to argue against what Mr. Carney is saying, that having no deal is better than having a bad deal. But for now, still wait and see. But we hear that they are still talking. So let's see where that leads us. So the new tariffs around the globe. Now the tariff, the floor is at 10%, but the average is 18 to 20%. So here we are, Liberation Day 2.0. Now maybe looking at the U.S. economic data, we have the GDP numbers. Volatile in the first half of the year, but the domestic economy is slowing down. So on the left, you have the GDP figures, which came out this week for Q2 in the US, a rebound in the second quarter. So that was what was expected. So the chart on the left, the line is the quarter over quarter GDP growth. Negative in Q1, positive in Q2, but what's hidden behind that is that this has imports and inventories all over it. So you need to look through the noise. The red segments on the chart on the left are the impact of imports on GDP. So if you import more, this is negative for GDP, and if you import less, this is positive for GDP. So this is how accounting works. So in Q1, what we've seen is U.S. businesses importing much more to front load, to get in front of the tariffs and raise inventory. So that's the blue-green part of this chart. This is the change in inventory. So in Q1, lots of imports, storing this into inventories, and then in Q2 importing much less but drawing from inventories. So overall that kind of muddies the picture. So you need to go to the chart on the right where it's final sales to private domestic purchasers. So this is really the core part of the economy, everything that is private and that is domestic. So you exclude trade and you exclude the government. And as you can see, over the last 2 quarters, this growth went from about 3% a quarter to 1.9, and then 1.2. So does that mean that the US is about to enter a recession? Not at all. Does that mean that this trend will continue? Well, likely, but we don't know that yet. What we do know is that the US economy is slowing down. The domestic economy is slowing down. And this is starting to show, for example, in the labor market, because this morning, on Friday morning, we got the latest non-farm report in the US. It was a very surprising report. The first miss in 5 months. What was expected was 104,000 jobs created, and we got 73. So that's below. But the last 2 months, the revisions were minus 258,000. So I don't remember such strong revisions despite, let's say, the COVID period where the data was all over the place. So it does show that the US economy, it seems to be slowing down. At least the labor market seems to be slowing down. The domestic sales, as I showed, they are clearly slowing down. Is this the start of the trade uncertainty that is showing up in the data? Maybe. We've heard also this week that businesses are starting to think that maybe the productivity gains from AI will lead to less jobs creation. So is some of that starting to creep into the data? Maybe we need a few more data points, maybe a few more months to have a clear picture on the labor market. But what seems to be clear right now is that the US economy is slowing down, at least because of all of the uncertainty that is floating around. So this is where we stand in the US. And now that leads us to monetary policy, because this week we had the Bank of Canada and the Fed. So the charts here on the left, you have the Fed. The Fed cut by 50, then 2 times 25 basis points over the last 12 months. But now they've been sidelined for a while. So the market was expecting the Fed to cut with about 70% odds as of Tuesday, before the Fed decision. When Powell spoke, he sounded quite hawkish, so that means less leaning towards cuts. So the market started depricing that less than 50%. But now this morning, because of the non-farm, the weakness in the labor market, we're back to 70%. So what that means is that there's 2 paths here by which the Fed can continue cutting. The optimistic one is that trade goes away, or at least the impact from trade is much less than what was expected by economists, and inflationary pressures don't show up that much, and the Fed is comfortable just recalibrating its position to help to support the economy, to be in line with a solid economy or decent economy with not too much inflationary pressures. The pessimistic one is that trade hurts the labor market strongly, and then the Fed has to step in to support the economy by cutting rates. So it seems that we've made one step towards the pessimistic scenario this week. It's just one step. We're still far from that. We still think that the Fed's going to have a hard time cutting before the end of the year because of the inflationary pressures. But where we might be wrong is that maybe the labor market deteriorates more quickly than we thought. The trade finally, starts hitting the US economy more strongly, and then the Fed is forced to cut for negative reasons. So the reaction of markets would be different in both of those scenarios, but this is where the Fed is standing now, pretty much boxed in and having 2 options, the pessimistic one seeming more likely as of now. For the Bank of Canada, we're at 2.75. We were at 5 last summer. So we can say mission accomplished for the Bank of Canada. Inflation is back towards the target. They are at neutral at 2.75. Maybe they can keep cutting at least once by the end of the year just to support the Canadian economy. But if they stopped here, we could say mission accomplished. And now it's time for fiscal to do its job. And fiscal will have an update on during the fall. Maybe this is what the bank will be waiting for as well, to see what comes out of fiscal. And then it's an exercise between the two to try to calibrate policy as best as it can. But the weight is not on monetary policy anymore. Now it's on fiscal, and Bank of Canada can start breathing, but it still does have a bias towards more cuts. This is what they told us this week. So what we'll be watching next week is going to be a very eventful week again, likely with market reactions and maybe new deals announced and all this. So we'll see what happens. But for Canada, we'll have the S&P Global PMIs. We'll have our employment report. 20,000 in July is expected. The average this year so far is 25,000 a month. So pretty much clear, near the average. And unemployment rate should be at about 7% in July. And in the US, we'll have numbers on exports and imports. So of course we'll see how things unfold over there. And ISM services index should remain in growth territory. The services sector remains solid. So this is a plus for the U.S. economy, but we'll see how things evolve here, given the weakness in the data that we've seen recently. So again, the next 2 weeks will be off. The next edition will be on August 22nd. So always a pleasure to serve you. If you enjoy the content here, please share and come back again on August 22nd.